I think the ultimate goal of investing, it isn't actually about what you make.
Right. It's really about what you keep.
Exactly. I mean, it is entirely about what you keep. But what if keeping your wealth in the future meant, just completely abandoning the traditional stock market?
Yeah, or moving your entire retirement into, like, a crypto wallet.
Right. And using these massive algorithms to aggressively short stocks just to dodge taxes. I mean, welcome to the deep dive.
Yeah, today we are getting into something really wild.
We are. We have our hands on this fascinating stack of transcripts from a recent earnings call and a Q&A session with BlackRock's leadership. And it details their 2030 strategic plan.
Which is, I mean, it really is a blueprint for the next decade of finance.
Yeah, so our mission for you today is to uncover how the world's largest asset manager is radically rewiring the global financial system.
We're looking at a fundamental shift away from, your standard boring portfolio of stocks and bonds.
Totally. We're going to explore this future built around algorithmic tax optimization, natively digital assets, and funding massive physical AI infrastructure.
Right, while blending public and private markets into just one completely seamless ecosystem.
Okay, let's unpack this because I want to start with that core premise, right? Keeping what you make.
Yeah, the tax piece.
Exactly. The source material kicks off with this heavy focus on their acquisition of a platform called Aperio. And the leadership drops a quote that I just think perfectly nails the reality of being an investor.
Oh, the one about paying for things.
Yes. They said clients don't pay for education, home security, and well-being with asset class returns. They pay for it with after-tax dollars.
Which is such a profound pivot from how Wall Street usually operates.
Right, because historically, the whole financial industry has just been obsessed with gross performance, chasing the highest percentage return possible.
Exactly. But they acquired Aperio specifically to make optimized after-tax returns the new baseline.
It kind of makes me think of getting, your first real paycheck, You see that gross salary number on your offer letter, and you're just thrilled.
Yeah, you feel rich for about a week.
Right, and then you open the actual envelope, you see the net salary after taxes, and you just want to cry.
Totally. And traditional investing has basically been selling us on the gross salary this whole time.
Yeah. But if you make an 8% return and end up paying, say, 3% in taxes and fees over 20 years, you don't just lose that 3%.
No, you lose the compounding effect of that 3%, which is huge.
It is. It can literally have your retirement nest egg over a few decades.
And that compounding drain is exactly what they were trying to engineer out of the system.
So how do they actually do it?
Well, they're deploying technology that used to be, strictly reserved for high-level hedge funds. Specifically things like direct indexing and tax loss harvesting.
Okay, let's actually pause there because those terms get thrown around a lot. But for anyone who hasn't used them, tax loss harvesting is essentially finding the losers in your portfolio, right?
Right. You find the stocks that are down.
You sell them to capture the loss, and then you use that paper loss to legally cancel out the taxes you owe on your winners.
Exactly. But the catch is, to do that effectively, you need direct indexing.
Why is that? I mean, can't I just use a regular fund?
Well, no. If you just buy like a standard S&P 500 index fund and the overall market goes up, you can't harvest anything. You just have a gain.
Oh, I see.
Right. Direct indexing means a computer algorithm actually goes out and buys fractions of all the individual 500 stocks for you.
Wow. Okay.
That way, even if the overall market goes up, the algorithm can spot, the 45 individual companies that went down. It harvests those specific losses to lower your tax bill while keeping your overall market exposure exactly the same.
And the numbers they're reporting in this call show this is catching on like wildfire.
Oh, the growth is massive.
Yeah. I mean, Aperio's assets under management have quadrupled to near $200 billion.
It's staggering.
And their 2026 flows are already sitting at $20 billion, which beats their record $15 billion from last year. Plus, across their separately managed accounts and model businesses, they are closing in on $800 billion.
Yeah, the demand is clearly there.
But I have to push back a little bit here. I mean, why is this suddenly a massive structural growth theme now? Haven't investors literally always hated paying taxes?
Well, sure. The desire to avoid taxes isn't new at all. What's new is the computing power.
The computing power.
Yeah, what's fascinating here is they now have the processing power to do it at an industrial scale across incredibly complex assets.
Okay, so it's not just standard direct indexing anymore.
No, the real unlock they discuss in these transcripts isn't just basic tax loss harvesting. It is the integration of complex long-short strategies into this tax optimization.
Okay, yeah, I saw that in the notes, like the 13E30 strategy, and I need you to explain this one to me. Because I know a 13E30 strategy basically means you take 130% long positions betting the stock goes up, and then 30% short positions betting the stock goes down.
Yep, that's the basic mechanic.
But how on earth does shorting a stock help optimize my taxes? I don't get that part.
It's all about generating specific types of cash flow and realized losses. When you short a stock and it goes down, you make money.
Right.
But more importantly for your tax bill, the actual mechanics of short selling generate realized losses and offsets that can be algorithmically paired against massive gains you might be making elsewhere.
Wait, like where?
Like in illiquid private markets, for example. It's essentially playing tax Tetris at light speed.
Tax Tetris. I love that.
Yeah. You are offsetting the huge gains of a really illiquid asset with the strategic, calculated losses of a hyperliquid short position.
Which you could never do manually.
No, doing this manually is impossible. Doing it with algorithms makes it a whole portfolio phenomenon.
But wait, managing an account that actively shorts stocks for taxes, holds all these direct indexes, and invests in illiquid private markets all at once. That sounds like a logistical nightmare.
It is.
Right. Like, how is a standard financial advisor or investor supposed to track all that, buy and sell it, and collect dividends without the friction of the traditional banking system just completely slowing it down?
Well, that logistical hurdle is exactly what drives step 2 of their 2030 strategy.
Which is?
Migrating everything natively onto the blockchain.
Ah.
Yeah, they aren't trying to squeeze all this complex maneuvering through legacy bank clearinghouses anymore. They are targeting the 5 billion digital wallets that already exist globally.
5 billion wallets. I mean, that's most of the adult population of the planet.
It is. And the firm is already managing $110 billion connected to digital assets right now.
Wow.
And they have a target to build this into a $500 million revenue business by 2030.
That is wild. And part of that is what, the $60 billion in reserves they manage just for Circle?
Exactly. Which underpins about a quarter of the entire $300 billion global stablecoin market.
So what does this all mean for you as the user? If you're listening to this, it almost sounds like traditional Wall Street is just, packing its bags and moving its headquarters into Venmo or a crypto wallet.
That's a great way to think about it.
I mean, I noticed they mentioned filing with the SEC to tokenize money market funds. There's one on the Ethereum network and another digitally native strategy focusing on daily dividend reinvestment.
Yeah, and that daily dividend detail is the critical mechanism here.
Really? Why daily?
Well, imagine owning a money market fund in a digital wallet. The dividends aren't being held up for 3 days in some antiquated bank clearing process.
Right, waiting for funds to settle is the worst.
Exactly. Instead, they are paid out daily, directly on-chain, and they land in your wallet natively as stablecoins.
So the investor never actually has to convert back to US dollars at a traditional bank?
Exactly. If we connect this to the bigger picture, that is the real threat to traditional banking. And it's a massive opportunity for capital markets.
Because the money never leaves the ecosystem.
Right. It bridges decentralized finance, or DeFi, directly with traditional assets.
Right.
If the subscriptions, the redemptions, and the dividends all happen on-chain without ever routing through a standard bank account, it creates an entirely new distribution channel.
Wow.
They actually call tokenized assets the spear tip to accessing these $2 trillion of global crypto wealth, bringing it seamlessly into traditional investment products.
It's just mind-blowing to think about holding treasury bills next to Bitcoin in the same exact digital wallet.
Yeah, the lines are blurring.
But, digital money, no matter how efficient it is, it's just numbers on a screen.
True.
It doesn't pour concrete, it doesn't build physical things. And the transcripts take a really hard pivot here, moving from digital wallets directly into the dirt and steel of massive physical infrastructure.
Because the real world needs big money. Or, I guess more accurately, the modern technology revolution needs big money.
And this brings us to their integration of HPS and GIP, right? These two major alternative investment and infrastructure firms they acquired.
Yeah, massive acquisitions for them.
I know the demand for this infrastructure was huge, but pouring concrete for data centers and building energy grids requires just a staggering amount of cash. Where is all this private capital actually coming from?
A massive chunk of it is actually coming from insurance companies.
Wait, really? Insurance companies?
Yeah. Just in 2026 alone, the leadership noted they've closed $10 billion in high-grade and infrastructure debt mandates, specifically for insurance clients.
But let me play skeptic for a second here. Because insurance companies are notoriously conservative, heavily regulated entities.
Absolutely.
So why on earth are they suddenly eager to lock up their money in illiquid private credit deals? Especially right after the broader market saw some real idiosyncratic risks in private credit just a year or two ago.
Well, to understand why they do it, you really have to look at their liabilities.
What do you mean?
Insurance companies know roughly when they will have to pay out policies, right? And it's often decades into the future.
Right, life insurance, things like that.
Exactly.
Yeah.
Because they have a long time horizon, they're willing to lock their money up for years just to squeeze an extra 150 to 350 basis points of yield over standard government bonds.
Okay, let's contextualize that for a second. 150 to 350 basis points is basically an extra 1.5 to 3.5%.
Right.
To a regular person, that sounds like a tiny bump. But at the scale of hundreds of billions of dollars, that tiny percentage is an absolute fortune.
A massive fortune.
Yeah.
And BlackRock currently manages $800 billion in insurance assets.
800 billion.
Yeah. And they noted that moving just 5 to 10% of that money into these private infrastructure deals creates an enormous lift for their own revenue. Plus, they mentioned that credit quality has stabilized recently, which makes these conservative insurers much more comfortable.
Okay, so that explains the supply of the money. But what is driving the sheer desperation for the infrastructure itself?
The hyperscalers.
The tech companies.
Exactly, the giant tech companies building the backbone of artificial intelligence. These companies used to run asset-light software businesses,
Right, just code and servers.
But now, suddenly, they need massive, capital-intensive data centers and entirely new power grids just to run their AI models.
Wow. Yeah, I didn't think about the power grids.
It's huge. And the sheer scale of the debt required for this is way too big for traditional public bank lending. It demands private partnerships.
And the mechanism here relies on something called the J-curve, right?
Yes. So think of infrastructure investing like planting an orchard.
Okay.
For the first 5 years, you were just spending massive amounts of money on land, water, fertilizer, and labor.
You're just bleeding cash.
Exactly. That is the dip in the J. You don't get a single apple. But in year 6, the trees mature, and suddenly you have a massive recurring harvest for decades.
Oh, I see.
Because insurance companies have deep pockets and immense patience, they are the perfect partners to ride out the dip of that J-curve.
Wow. And the scale of this orchard, so to speak, is just massive. The transcripts outline a $400 billion target for gross fundraising in private markets from 2025 to 2030.
Yeah, it's a gold rush.
In just the second quarter, they saw $15 billion flow into private markets, $6 billion into private credit, $5 billion into infrastructure deals like take privates and data centers.
Right, like the AES take private they mentioned.
Yes, and another $3 billion into a Latin American outsourcing mandate. It's wild.
It really is. But what's equally fascinating is that this structural shift isn't just happening with, insurance giants and tech monopolies.
Right.
Retail investors globally are totally changing their behavior in ways that are rewriting capital flows.
Yeah, especially in Europe, the transcripts highlight this major inflection point. The democratization of investing in Europe just crossed the $1.5 trillion mark in ETFs.
Yeah, with $80 billion in net flows just this year alone.
And we are seeing a shift in how they allocate, too, because for a long time, global retail money just, defaulted to buying U.S. tech stocks.
Right. Everyone wanted a piece of Silicon Valley.
Exactly. And while the transcripts note that global allocation to dollar-based assets is back to its absolute fullest level, beneath the surface, there's this new nationalization trend.
Yeah, this is interesting.
European investors are using these accessible ETFs to finally invest heavily in their own domestic economies, which is maturing their local capital markets.
But here's where it gets really interesting, though.
Oh, yeah.
Because mixed in with this mature, sensible domestic ETF strategy is a glaring anomaly regarding crypto.
Oh, right. The Bitcoin ETF thing?
Exactly. In the quarter they discussed, Bitcoin and Ethereum dropped by 30%. I mean, a total market crash.
Yeah, bloodbath.
But despite that 30% drop, The European Bitcoin ETF saw over $650 million in net inflows.
Wait, if the asset is crashing, why is traditional conservative European retail money flooding into it? That makes no sense.
Well, it does when you realize the mindset has fundamentally changed. In the past, retail crypto was a speculative gamble. You buy it hoping it goes up 1,000%, and you panic sell the second it drops 30%.
Yeah. Purely emotional trading.
Exactly. But what the data shows is that traditional investors are now treating crypto through the lens of disciplined portfolio construction.
Meaning they aren't trying to time the market anymore?
Precisely the opposite. They're using ETFs to make a standard 1 to 2% allocation to crypto just as a diversifier.
Okay, I follow you.
So if you have a strict rule that your portfolio must be 2% Bitcoin and the price of Bitcoin suddenly drops 30%, your portfolio is now out of balance.
Oh. So a disciplined manager doesn't panic.
Right, they rebalance. They buy the dip to get that allocation back up to 2%. That $650 million in inflows wasn't wild speculation. It was the robotic, disciplined rebalancing of traditional portfolios.
Wow. Crypto's basically become boring.
Yes, it has.
And BlackRock is perfectly positioned to capture all of that ETF flow, whether it's crypto or domestic European stocks, because of their distribution strategy.
Right, their partnership model.
Yeah, they emphasize in the Q&A that they don't charge tolls on their index ETFs. They aren't trying to squeeze their distribution partners with platform fees.
Because they play the long game.
Exactly. Instead, they want to be the underlying engine that helps wealth managers transition clients from traditional brokerage accounts into fee-based advisory accounts.
And they do that by providing the indispensable tools, platforms like Aladdin Wealth and Advisor Center.
Yeah.
Which actually lead us to the final piece of this 2030 vision.
Right, because if you step back and look at this entire ecosystem, algorithmic, after-tax, long-short optimization, tokenized money market funds paying daily on-chain dividends, physical data center debt, and global retail ETF flows, you need a centralized brain to manage the chaos.
You do. And for this ecosystem, that brain is Aladdin.
Supercharged by their recent acquisitions of Prekin and eFront.
Exactly. It is a highly profitable technology stack. Their tech revenue grew 13%, with annual contract value jumping 15%.
You know what I found really compelling about that part? It's how regulation is actually driving this tech adoption.
The safe harbor rule.
Yeah. They talk about the Department of Labor's Safe Harbor Rule, which now demands rigorous data and performance benchmarking for private assets inside retirement accounts. So, if you're listening to this and you have a 401k, you're probably used to logging in and just seeing a generic pie chart that says healthcare or real estate.
Right, it's super vague.
Yeah.
But fiduciary standards are changing.
Exactly.
Investors need to know if that healthcare slice is actually investing in physical hospitals with steady cash flows, or if it's secretly just healthcare IT.
Which is completely different.
Exactly. Healthcare IT is basically venture capital software and carries a massively different risk profile than a physical hospital.
So what this tech stack does is allow an advisor to look deeply inside a 401k and see exactly which physical data center in Ohio, your money is funding.
It brings public market transparency to private market shadows.
And because BlackRock owns the data pipelines of Prekin and eFront, they own the transparency.
And owning that data moat results in a staggering margin flex.
Oh, the numbers are crazy.
Yeah. They reported an operating margin of 45.9%, which is the highest in nearly 5 years.
Wow.
Furthermore, the acquired private market businesses like GIP and HPS are running at north of 50% fee-related earnings margins.
That margin number is just wild. I mean, they have a stated 2030 goal of generating over 30% of their total revenue from these private markets and technology services, specifically to dampen their sensitivity to the stock market's ups and downs.
Right.
They even teased that back in 2021, before they had this massive scale in private markets and tech, they hit a 47% operating margin, implying they fully expect to blast past that number.
Which really forces you to rethink what kind of company they actually are. The leadership explicitly stated their ultimate destination is a seamless analytical platform. No one on Earth has fully achieved the perfect blending of public and private market data and risk assessment on one single screen yet.
But if they are pushing toward margins well over 50% and their core growth engine is a singular tech platform blending public and private data, I mean, are they fundamentally transitioning away from being an asset manager?
This raises an important question, doesn't it?
Yeah. Are they basically becoming a Silicon Valley-style software enterprise that just happens to manage money on the side?
Well, becoming the definitive operating system for global capital is how you engineer those software-like margins for the next decade.
It is such a wild vision of the future. I mean, we started this deep dive looking at algorithms dodging taxes by shorting stocks.
Right.
And then we moved to Wall Street, migrating natively into digital wallets, physical AI data centers funded by conservative insurance money, riding the J curve. And finally, this singular supercomputer managing all of the data.
It illustrates how the very concept of an investment is evolving. It's hyper-personalized for your taxes, it's digitally native on the blockchain, deeply tied to the physical world, and entirely benchmarked by software.
But it leaves us with one massive lingering question.
What's up?
If we are truly accelerating toward a future where every asset you own can be tokenized and held natively in a digital wallet,
Yeah.
and illiquid private market assets can be seamlessly traded and benchmarked right alongside public stocks using this master technology, will the traditional public stock exchange, places like the NYSE, eventually become obsolete for the average investor?
Wow.
Will we wake up in 2030 living in a completely privatized, on-chain financial ecosystem?
I think that is the quiet implication of this entire 2030 strategy. As the barriers between public, private, and digital assets dissolve, the need for a centralized traditional exchange diminishes.
That is definitely something to seriously mull over next time you look at your portfolio. Thank you for joining us on this deep dive. Take a hard look at where your own assets are sitting today and ask yourself what keeping what you earn is really going to look like in this entirely new era of finance. Catch you next time.